What we're going to do now is focusing on getting all that kind of rough tabular knowledge that we have about the effects of taxation on decisions and moving all that knowledge back into something that everyone else can read. And so what we're going to be doing is embedding that back into an income statement in cash flow form. The main point of this is to use all of those conventions that you have in accounting so that there's no question about what sign you're dealing with, how to interpret a column. I mean, those are all taken care of once you're back into an accounting framework. It's also important because this is the way that you're going to be communicating with other people. You can't just kind of throw up a rough spreadsheet and have everything work out so everyone knows what's going on. What you really need to do is get into a format that people are used to seeing items in. And an income and cash flow statement is the way to look at that because people can identify what this part's supposed to be, and you can easily see the kind of cash flow projections that are there. So let's start with our income statement, our thing which is up here at the top. And what we're going to do is we're going to simulate the purchase of a vehicle, and again this is just a $10,000 car. And what we're going to be doing here is identifying in the income statement what changes in the income statement because we're purchasing the car. So we're looking at all the consequences of this particular purchase. So what we have here on the operating revenue is something which says $1,000. What that means is that because we purchased the car, we've decided that because of that particular purchase, that we're going to see an increase in sales because we got it. Maybe this new vehicle has motivated the salesperson, and so that they're going to be much better at going ahead and selling our product. Maybe this has something to do with the person getting there from place to place faster and faster, so they're able to see more customers. But the point is that we have decided because we are purchasing this vehicle, we're actually going to have an increase in sales of $1,000. And that's what I'm pointing out right here, is that this positive number means that we're going to see an increase in sales in our operating revenue. Now this $1,500 that I placed down here on that operating expense, which is the pair to the operating revenue, says that because we're purchasing this vehicle, perhaps replacing another vehicle, we have a reduction in expenses of $1,500. It could be that this new vehicle that we purchased, say, is more fuel efficient, or the insurance is lower, or there are fewer maintenance expenses. But the idea is that something is going to be less expensive to operate by about $1,500 a year. What we're looking at here is please noting that negative numbers means we're seeing a kind of decrease there. Now, what I've done is I've taken this $2,000, which is that first year's depreciation on the vehicle, included it there, and that's just one of those important parts of the income statement. Now, what I have in this cell is just simply the revenue, that $1,000, that increase in revenue, less the two expenses that we've included so far in the income statement. Now, that's supposed to be our taxable income. The tax line that I have here, we're just using a rule of thumb tax of 50%. So you use that if you're not quite sure. It's one of the two rules of thumb. And all I've done here is just said that, well, our taxes are going to be half of our taxable income. Now, please note that in real life, taxes don't work out that way. And in fact, what you're going to notice is that when you're constructing these income and cash flow statements, that some of you are going to be focusing on certain sections. So, for example, the economist may be out there trying to figure out what the operating revenue is going to be. They're estimating demand functions and such. The engineers may be focusing on the expense changes that are there because we're dealing with this particular change, while as the MBA types are looking at all the different ways that they can arrange these purchases in order to minimize the tax liability. Okay, so please note that this tax thing isn't quite going to be as formulaic as I'm depicting it in real life. That's part of the reason why we're using a rule of thumb tax rate. Now, the net income that we have right there is just going to be the taxable income less the taxes, and that's that benefit that's there to the owners. Now, the net income feeds into the other part of the income and cash flow statement, which is the cash flow component. And this thing, because we are just looking at something very simple, which is the purchase of a vehicle, has only two of its three components. We have the cash from operations and the cash from investments. So the first source that we're going to have right here is our net income, which is literally just the net income that was there before at the bottom of the income statement. And we also have the source of cash, the depreciation. And so it flows back in because it's that special expense that the check never goes anywhere. It's still available for us as cash. So these are two sources of cash. And what you're going to notice is that Positive numbers means that there is more cash available. So here we are dealing with this increase in cash available to us because we purchased the vehicle. The other category that we're going to have is going to be investments, and what we said is that we're going to have this special account for our car. We spent $10,000 cash, and we see this negative number here, which indicates there's the cash that is flowing out. Remember, the convention on cash flow statements is that positive numbers mean cash flowing into the firm, negative numbers mean cash that's flowing out. The bottom of the cash flow statement is just going to be the sum of the sinks and sources of cash. And so literally what you're doing is you're just adding up that source of cash, that income statement, that source of cash depreciation, and that sink of cash, which is the car. And that's our base that we're looking at on our income and cash flow statement. We'll be making some interesting adjustments to it later to show other effects.